Welcome to Final Financial, your final financial stop. This is the best place to learn about investments and how you can increase your portfolio, as well as credit card advantages, taxes, insurance, and much, much more. If you subscribe to my YouTube, you'll learn all about this. With my Patreon, you'll be able to learn about fundamental and technical analysis and your favorite picks for the next week. With that being said, I want to say this is not financial advice. I am not a professional in any formal way. I have been doing this for many years with many trade organizations, and this is just what I've picked up and what I've learned throughout the process. Now, please understand that investments are extremely risky and that you can lose everything, but you can also win everything. So please do your own research and not just rely on my sole information, because I may not even cover everything you want to know. With that being said, let's jump right into it. Today we're going to be talking about investing. What is it? What are the different types of strategies? What are the different types of investing? And lastly, what is risk and reward? So jumping into it, investing is allocating resources with the expectation of generating income or profit. This could be putting $1 in and hoping to make $1 back. This could be buying real estate and selling it later for a profit. This could also mean buying fine arts and antiques and selling it later for a profit. All types of investments have risk and are usually weighed with the reward at the end. So lower risk, lower volatility means lower reward, but still very safe for you to invest in. Higher rewards come from higher volatility and higher risk. These include options and commodities. We will all get into that later, but this is just a brief overview of what investing is and how can you put your foot into the door. Aside from price appreciation, there are other forms of ways that you can make money from your investments, such as dividends and bonds. Dividends are paid quarterly, and those are the expectations of income from the companies and businesses. So if you have 100 shares, maybe that company will offer 2 cents per share. So at the end of the quarter, 2 cents times 100 is $2. You just made $2 by just holding those 100 shares. Apple, for instance, they split their stocks and it gets very complicated, but Apple is a company that provides dividends. So if you wanted to earn money while just sitting back and letting your money work for you, that would be the way to go. But please, like I said, do your research. Dividends make up about 1/3 of the market since the 1950s, which means 2/3 of the market include money that people have put in themselves. So 1/3 of it comes from just accumulating wealth. So the lower rewards obviously offer lower risk and lower volatility. This includes certificates of deposit, bonds, and fixed income instruments. And then as we go down the list, you'll see stocks and equities, options and derivatives, and commodities all fit towards the higher volatility, higher risk, higher reward category. So jumping straight into it, certificate of deposit is a product offered by banks and credit unions, all of them. And they provide an interest rate with your lump sum deposit untouched for a specific amount of time. It's up to the bank's discretion to set the terms and the rates and what the penalties are for early withdrawals. So there are lower opportunities for growth here, but it is a non-volatile guaranteed rate of return. Stocks are found through many exchanges and brokerages. You can do it yourself, or you can hire somebody to do it for you for a percentage of your returns. And when you purchase these stocks, they're also known as equities. By this, a buyer becomes a fractional owner of the company, and you are now known as a shareholder. So if you have 100 shares in Apple, good for you, but you also have a fractional percentage, you own 100 shares of Apple. So you now have voting rights, and anything they wish to do with their company, you can enlarge they can choose to enlarge their facilities, they can expand into new markets, they can pay off their debts, all because you decided to invest in them. Because of that, some companies offer dividends, so they reward you. Lastly, people buy stocks to earn appreciation, like I said, dividends, and the ability to vote in shares. Bonds are a little bit different. Bonds use government and business entities to essentially pay off their debt. So this debt obligation that they have, they pay you in interest payments. They don't pay you in dividends. And because of these interest payments, you also have a maturity date of the face value. So if you were to buy $100 in bonds, and throughout that time, if it takes a year, there are 4 quarters in a year, you would get interest payments 4 times that year. And at the very end of the year, you would need to be repaid your original investment as well as that interest. Otherwise, the business faces default. And that's never fun, because bonds are basically borrowed money. You are letting the company borrow your money. Rather than investing in stocks, you are giving the company your money in hopes for a return. Bonds are typically a little bit safer, but for the most part, still just as risky. Funds are a little more complicated, mainly because they have to do with a large collection of pooled investments. This can include stocks, bonds, commodities, preferred shares, different things like that. Mutual funds are not traded on the exchange and are valued at the end of the trading day. Exchange traded funds, or ETFs, are like stocks and found on the exchanges, and their value is valued constantly. They are valued constantly. So throughout the day, you can buy into an ETF, and at the end of the day, you can sell an ETF depending on the ratio of your win or loss. Mutual funds charge annual fees. Those are known as expense ratios, and you do not have voting rights when buying a mutual fund. NAVs, or the net asset value, is what determines the price of these funds. The best way to find that out is the total value of the securities, the total money circulating, divided by the number of shares outstanding, which means the number of shares that they have available to trade. ETFs track indexes and sector commodities and are purchased like stocks, as said before. Most popular option is SPY, which tracks the S&P 500. And the S&P 500 is a collection of 500 companies managed by hedge funds, by managers. They basically put together a good group of 500 companies and let it play out. Now, Apple has a $2 trillion market cap, so Apple's volatility is going to play a bigger role than a smaller, $500,000 market cap company. So if Apple goes up $2 and that $500,000 market cap goes down $2, the S&P 500 is most likely going to move up because the Apple share, the Apple stock, has more weighted value. There are also investment trusts. Investment trusts are basically like investing in a company. The most popular is a real estate investment trust, or a REIT. Basically what you do is you put money into this investment trust, and you are then paid a percentage of the monthly rental income from their commercial, industrial, or residential rental payments. So it is safe to say that as long as that company upholds their tenancy, and they can provide, you are getting paid. Options and derivatives are a little bit more complicated, but just like I said, a brief overview of everything. Derivatives are contracts between 2 or more parties in which the contract value is based on an agreed upon security or set of assets. Derivatives include swaps, futures, and forward contracts, and options are a form of a derivative. Options are one category that give the holder the right, but not the obligation, to buy or sell a set of assets at a specific price within a specific time period. So for instance, I can buy 5 contracts that will reach a certain price by a certain time. If it doesn't reach that price within that time, the contract is valued worthless. You are then out of the money, you make nothing essentially. But if that price hits what you expect it to by that time period, that is where your gains come into fruition. Commodities are probably the most versatile as well as volatile investments that you can make. Commodities have to do with the inputs into other products and services. So for instance, oil, wood, grain, since technology is changing, minutes and bandwidth are even becoming commodities. Things that are not commodities, such as technological innovations, so like a Tesla car and a Toyota car. The reason why they're on their own platform is because they are different. They operate different. They use different technology. They function differently. So they are not a commodity. You can purchase those as an end result. Oil essentially is oil no matter where you get it. Wood is essentially wood no matter where you get it. That's why they are all valued as one commodity. So it's very difficult to kind of grasp by just looking at the big picture. But later on down the road, I will go into each and every single one of these investment strategies, these investment types, and we'll talk a little bit more about it so you can fully understand and grasp the idea of it, and maybe you can make the move into it yourself. So there are different investment strategies. There are active investors which hope to beat the market. Typically, an ETF will make about 10% returns a year. So if you put $100 in, you hope to make $110 by the end of the year. It's not always the case, but for passive investors, that is what they like to do. Active investors like to swing trade. They like to hold positions for a shorter amount of time and accumulate growth within their transaction. Growth investing usually has to do with higher price to earnings ratios, whereas value investing has higher dividend yields. So if you want to invest in Apple, you may not see a jump from 100 to 200 in a day, but you will receive dividends every quarter, and then that's how you build up your wealth. So there's lots to go into investing and how you can invest and where should you even start. There are tons of online brokerages. There's Robinhood, there's Webull, there's TD Ameritrade, and then you can even go into cryptocurrency, which I haven't even covered in this video. But cryptocurrency, you can use Coinbase, Binance, Crypto.com. There are tons of different ways that you can start with as little as $5 to $10. You don't need to buy a whole stock. You don't need to put in $180 into Apple to buy one stock. You can put $10 in and receive a fractional amount of that return. This is the case with Robinhood. I understand that Webull might be a little bit differently, but for the most part, you don't have to buy a full stock. You can invest on your own accord. You can invest on your own terms and strategize based on your budget. We'll talk about budgeting. We'll talk about more investing strategies. We'll talk about so much more. Stick around, stay tuned, and I really do hope you enjoyed this content and you learned something. If not, please leave a comment, reach out to me on Twitter, subscribe to my Patreon to access all different types of information that you didn't know before. Have a good day.